Traders, and welcome to the June 2018 Trade of the Month. And the Trade of the Month we're looking at today is a signal that was called on May 31st, 2018 to go long Electronic Arts, to go short Zynga Inc. in these amounts that you see here in this trade alert. So it was to go long 76 shares of Electronic Arts at 130.36 a share, go short 2,294 shares of Zynga at 437 a share. The first thing we do when we get an entry signal like this, if you haven't done it previously, is to make sure that you're happy with the fundamental position of both companies, that they should be correlated from a fundamental point of view. So if we look at the profile, let's start with EA. So EA, you probably know it, Electronic Arts is one of the largest video game publishers in the world. They develop, market, publish, and distribute games, content, and services for all the game consoles, for PCs, for mobile phones, and tablets worldwide. You've probably heard of a lot of these names. Okay, they're the granddaddy of video games businesses, and let's quickly look at some of the statistics. It has Electronic Arts has a market cap of 43 billion and enterprise value of 40 billion, which means they have about 2.5 billion of cash on the books. But they are the granddaddy. They're not growing that fast anymore. They've got some quarterly earnings growth of about 7%, and they've got quarterly revenue growth of about 3%. And they trade on a 9 times price to book, about 8 times EV to revenue, and 26 times EV to EBITDA. So that's EA. Now let's take a look at Zynga. And Zynga also develops, markets, and operates social games as live services in the United States and internationally. And the company's games are played on mobile platforms as well as social networking sites, including Facebook. So these are two U.S. companies, both traded on NASDAQ, both headquartered in the same city, in the same industry, the video game industry. However, Zynga is a substantially different company. It's got a market cap of 3.5 billion versus 34 billion of Electronic Arts, and right there, that's it should ring an alarm bell for you, which is one's got 10 times the market cap of the other, and whether you like it or not, even if they're in the same sector and they are competing, those are fundamentally different companies because one is just so much more resistant to macroeconomic pressures than the other based on its market cap. So I would highlight that and say that this is fundamentally a risky trade because the match between the two businesses is not as close as you would want it. Price to book 2 times, which is a lot lower. EV to revenue is 2.8, a lot lower. EV to EBITDA is higher though, 34, and I think that's because you'll see that you get much faster growth at Zynga. You've got quarterly revenue growth of 22% versus 3% at EA, and their profitability is yet to be established. I think they're just about to become profitable. So, two businesses that are in fundamentally similar sector, similar product, they compete in certain sectors, but one is much bigger than the other. However, they're both American, they're both traded on the NASDAQ, and they are going to be impacted by the industry elements of their business very similarly. So you have to make a call as to whether that fundamental correlation is strong enough for you. Prima facie, I look at it and I say, I want to know more. I'm not saying yes, I'm not saying no. If it were a very attractive pair from a backtesting point of view, I'd say, okay, maybe we can deal with this and maybe we just take a smaller position size. So I would jump from the profiles to the last backtest just to see how attractive the pair is from a backtest point of view. And what we see is that over the last 3 years, and this is after the latest trade we're reviewing right now, the May 31st trade has actually closed because we're at the end of the month. We're actually in July 2nd right now. So 3-year look back, 12 trades. Here's an issue. Okay, when we put this into the top 30 US equity pairs, it was back in about November last year. Since then, the correlation and the co-integration have broken down. 0.36 co-integration and 14.4% correlation. And we'll see that in a little bit when we drill down that there has been a major breakdown, but it's started to recover now. So right off the bat, you have to decide whether that would just make you throw out the trade. Again, I'd look at historic profitability, and I would look at how that correlation breakdown has impacted how the pairs traded from a pair trade point of view, and whether it caused you to lose money or whether the trades were still profitable. And I would make a judgment call on that basis. I would also not trade it unless I could see that the correlation and co-integration were recovering very strongly. Sometimes two companies, if there's a fundamental event on one, it can move very, very far and very fast and break this correlation relationship, but then it reestablishes it. So why would I even want to continue looking? Well, this pair on those 12 trades has given you a compound annual growth rate of almost 24%, a profit factor of 7, max drawdown less than compound annual growth rate, but 22.9. You can see the equity curve here. Looks good, bottom left to top right. A little bit not too smooth. It's got some herky-jerkiness in there, but it's going the right way, and a lot of profitable trades. Over 10,000 earned in 3 years. Commissions about 12% of gross profit. Average net profit of trade 746, which is like we want to see at least that. Number of winners 83%, which is great. And your average days in trade, which I always look at, is about 31, so pretty typical. So after I looked at that, the back testing, I say, okay, we got the problem with the correlation co-integration, but hey, it's a very attractive pair, and if we look at the ratio, it's not trending. Lots of back and forth, up and down above the ratio line over that 3-year period. So says to me, there's something in this pair. It's definitely worth looking at for a trade. So that's the back test result. So then we go to, first off, I would take a look at the relative performance graph. Let's see if I have that. Yeah. So we want to see that this pair, this is relative performance over the last year. We want to see that they separate and then come back together, separate, come back together. So this separated, came back together, separated, came back together, separated, almost came back together. Now it's separating again. Much more volatility up in here. Something to think about. But prima facie, looks like the co-integration is there. They're separating, coming back together, separating, coming back together. So that looks pretty okay. Now, so what would we do at this point before we jump into the pair charts? I would always check news. So what are the 3 things we're checking when we check news? First off, is there a news event that has caused the fundamental value of either business to change, which means that the signal is generated by a fundamental value change as opposed to a liquidity-based signal? We're going to do that in a sec. The other 2 things we need to check. Earnings dates. We want to make sure that we're not within 2 or 3 days of an earnings having been announced, and we want to make sure we have at least 30 days between now and the next earning announcement so that our typical average trade duration has time to play out without being interrupted by an earnings announcement. So that's earnings on both we need to check, and then dividends we need to check on both. Well, let's do this quickly, and it is pretty easy. First off, Zynga doesn't pay a dividend, so we don't have to worry about Zynga's dividends dates. EA also doesn't pay a dividend, so dividend check, check. Now we go to earnings dates. If we look at Electronic Arts, their last earnings announcement was on May 8th. This trade signal we're reviewing right now is May 31st, so that means there's at least 2 months between now and the next earnings announcement. So check, we're clear on EA's earnings dates. Go to Zynga, where are we? Okay, the last earnings announcement, we don't even see it here. Let's go here, is May 2nd. Zynga announces first quarter 2008 financial results. Again, they won't announce again until about August 2nd. We're on May 31st. We have a 30-day average trade duration, so we've got at least 2 months. We're clear there. So clear on earnings, clear on dividends. Now it's just a question of what type of signal. Is it fundamental or is it liquidity? If we look at EA, Electronic Arts, nothing since May 8th in terms of announcements that would cause you to change your fundamental view of the business. So that seems clear. There's no fundamental move. So we then look at Zynga, and what do we see? Well, lo and behold, the day before the signal was generated, Zynga announces leading global market game, they acquired leading global market game developer Gram Games. Team behind it hit titles Merge Dragons and 1010. Okay, so alarm bells ring. There's an M&A deal here. Usually you would say, oh, that's the end of it. It's an M&A based signal. Fundamental values are changing. This pair, we're going to have to re-back test it and maybe even kick it out until we get a better trading history because it's become a fundamentally different business if it's merging. Well, do your homework. Always read what's going on. So the most important thing here is it says they're buying Gram Games for 250 million in cash and a 3-year earnout. So what does that really mean for the company? Well, it's got a 3.4 billion market cap, and they've got 700 million of cash on the books. So this is not a stretch for them. It doesn't change the leverage profile of the business. And 250 on 3.4 billion is only about 6 or 7%. So while it's significant and can lead to some re-rating of the business, some improved financial performance, it's not going to have a major impact. I would dig a bit deeper and see what they say about that. And if you look down here, they say Zynga remains on track to deliver results, excluding the contribution from Gram Games, in line with its original Q2 guidance as communicated in the Q1 2018 earnings call. So no fundamental change. Then you look for GAAP purposes, Zynga does not expect any significant revenue impact from Gram Games. And as the expected bookings generated in Q2 of 10 million will be accounted for as an increase in deferred revenue. And then there's an adjusted EBITDA to offset that. Net, what they're saying is short-term financially, this is not going to have a big impact on the business or its results or what's been previously announced. So that would say maybe the market's just having a headline reaction to the acquisition, and that this could be treated as a liquidity signal because the fundamental profile of the business remains the same, and we should therefore have a reversion to the mean. That said, you have to do your own analysis and decide whether Gram Games, despite the fact it's not going to impact the financials in the short term, may have caused a fundamental re-rating of Zynga because it's got some brilliant team with some brilliant titles, and that longer term that's going to re-rate Zynga as a business. That's something you have to make your own decisions about. But prima facie, I look at this and I say this could be liquidity based as opposed to fundamental driven, and let's keep going. So then from there I would go to review the pair charts. And if we take a look at the pair charts, the first one I look at is the ratio chart. Now this is 2 years going back, okay? What do you see? Ratio pretty flat, a little bit of trending in the last 6 months, but again above and below, which is what we like to see. So the first snapshot of that, I say it looks like a decent ratio chart, and these are out of sample trades that we've had since November. That one was entry, exit, made money. Entry, this is the one we're examining now, which, surprise, we know that it made money. But the last one did too. The last one before that also made money, but went badly offside, but actually ended up a little bit in the money. Previous to that, made money. This one, there was a blip. You'd have to check what kind of announcements there were that caused this to happen. And then the one previous to that, entry, exit, made money as well. So historically, it looks like it's a pretty good pair for making money, despite some of the limitations we've been seeing. And so that's the first bit about the ratio. It's non-trending, so that's good. Is there a breakout in the ratio with this signal? Well, no. You see it's actually well within the resistance and support levels. So that's also good. We're not facing a ratio breakout. Looks better as a possibility of reversion to mean. Is there RSI extreme? Yes, we are at 20 on this signal, which means it's very oversold, the ratio, so it might be snapping back. So we like to see that. That's good. And do we see any divergence? Well, it's very hard to see on a 2-year chart. Let me just change that quickly. I'm going to take all of these to 1 year, because 2 years gets bunched up. It doesn't really let you see things like divergences. And I'm going to redo. Okay, so let's get a new set of pair charts. So these are 1 year charts. So here we are. This is the signal. Is there a divergence? Well, ratio's declining. From this one, it's also declining. So if you drew a line like this, declining, and if you drew a line like this, rising. Okay, so there is a divergence between that trough and that trough on the RSI chart versus the ratio chart. Now you have to look through this one, but if you know your technical analysis, looking through some of them in order to see a wider divergence is a valid technical concept. And so I would say that's actually really positive. because I'm seeing a divergence in the RSI chart, and that says there's probably a better than normal probability that that's going to revert to the mean. So that's a big check for me. We've got the volatility chart here. We'll get onto that in a second. We usually also check where we stand on the plus minus. Are we at a very heavy extreme? No, we're actually just right on 2.0, which is how we've backtested this pair, so that's fine. But does it usually go way wider than that before reverting? And we see here, yeah, it did 3.5. Here it did 2.4, 2.5, 2.46. So, you know, yeah, maybe you'd get a better entry at 2.7 stretch or a 3 stretch, but that's not how we've backtested it, and that's not the way we've been trading it. So we're pretty comfortable with that. So that looks all right. And then finally, we would look at correlation. So I'm going to have to pull that chart up. So let's take out the volatility and put in the correlation. Okay. Here's where this gets complicated. You see this big correlation breakdown when all of this happened? That's pretty hard to get our heads around. We need to study deeper and figure out why that happened. But okay, that said, and I'll leave it up to you guys to do that. I'm not going to do that on the video. It takes time. But to determine whether, you know, historically it was very strongly correlated, then we had this breakdown, but now it's recorrelated. So I would want to see this over a longer period, look at it over 10, 5, 8 years, 3 years, see how it's behaved. But what is good is that the correlation is being reestablished. So this one's a negative. And you need to get your head around it. You can get your head around it by studying the fundamentals in the news over that period a bit better and forming your own opinion as to whether or not there was a fundamental value event that caused one to shift, but that now they should recorrelate at a new level and therefore continue to be good pairs to trade. That's the art of pair trading. You need to figure that out for yourself. Let's continue as if we were. On balance, I think that the setups are pretty good. You know, just recapping. The plus minus looks fine. The ratio, not trending, looks fine. No breakout looks good. Divergence on the RSI looks good. Extreme on the RSI looks good. Correlation's a negative. But I would say, yeah, you can make an argument to trade this one. It depends how much of a perfectionist you are and also what your position size would be. Given the fundamental risks we talked about earlier, I would want to keep a smaller position size on that. But as you know, one of the main things we look at for determining position size is, of course, the volatility of the pair. And if we take out the correlation chart and go back to volatility, you can see, look, this is 0.55. Okay, yeah, it's got more volatile, but it's extremely low volatility pair. We're used to seeing 1.5%, 2%, 2.5%, 3%, 0.55. So that's a mitigating factor on this entire setup. I would say that, you know, because it's a low vol, I'd be willing to get in here and try and have a go because there's a lot of other positive factors at play. I wouldn't trade this with a full position size though because of the reasons we talked about previously. The correlation breakdown previously, the fundamental mismatch on sizes of the companies, but the rest looks good. And the low volatility says, let's consider that it could be a trade. Again, up to you. You guys make your own determination. Okay, if you had done it, what would have happened? Well, let's go back to our trade signal. On the 14th of June, exit trade, the long position made $940 and the short position made about $45. So just under $1,000 net of all commissions. The gross profit was $1,118.11. So pretty nice trade. 11% on return in 14 days on 10,000 a leg. If you're using CFD leverage, and we would go maybe 3 times what the standard long short self-financing is, then you're looking at 33% on your equity in about 14 days. So it was a very profitable, very short trade. So despite the analysis having some reservations about the trade, the result was fantastic. So that's the June 2018 trade of the month, EA versus ZNGA. Happy trading, everyone.